Michael, you are welcome. Chukwebuka, Lakunle, and ITEL P15. If you could indicate who you are welcome. It's going to be an exciting and impactful class today. So I would love you to pay attention. Pay attention. If you have any question to ask, you can put it on the chat room. It's a class. It's not like you're going to be quiet all through. So feel free to ask your question on the chat room. All right? All right. Do have a wonderful time. We are going to be starting in the next 2 minutes. That's going to be 10 minutes past 9. So just exercise a little bit of patience. Thank you and do have a great one. So in addition to what have been said earlier, I want to believe most of you or all of you have seen the video that was sent to the group. Feel free to watch it basically on the course you are taking right now. Feel free to watch for a better understanding, all right? So wherever you are hooked up with question, feel free to ask your question. Please, if you have seen the video that was posted this morning, indicate on the chat room so we can go ahead. We are almost starting now. Please indicate that you've seen it on the chat room. All right, so without further waste of time, we are going to be welcoming our lecturer in the person of Mr. Samuel Ayanlakun. I'm sorry if I still got the pronunciation wrongly. Okay, so we are welcoming him right now. So, Mr. Samuel, you can take it up from here.
Yeah, good morning. Thank you so much, Madam. That's it. I still haven't gotten my name clearly. My name is Samuel Ayanlakun. So first of all, please, I want to know if I'm audible enough. Am I clear? Is my voice okay? So we don't have all
You are clear, but it's kind of cracking.
Okay. I just pray this network. Will be favorable this morning. But in a way, in the moment you discover that I'm not so clear, please indicate so I can always go back to the last you had me. Right. So,
all right.
So thank you so much. I'm trying to share my video to go live. Or I don't know if anyone has seen me. I'm trying to go. Okay. Good. So good morning, everyone. I believe we all had a very fantastic. Thank God for today. We're going to do the conclusion part of the of the accounting aspect today. We're going to conclude everything today. But I quickly want to do a recap of what we treated last Saturday. So if you were with me last Saturday, we talked about the history. So because we talked about the history of accounting, explain the concept and the principles involved in accounting, the generally accepted accounting principles that guide accounts wherever you are all over the world. I listed everything, of it. It's very important to know that. We also know the role of accounting activity in operation of an enterprise, in operation of a business. We know the role of accounting. The reason why you need to record, we also dealt extensively on that also. So we also state the significance of accounting activity in operation of the business. We did that. We talked about capital and revenue items. If you remember when I told you what capital items are and what revenue items are. So if you can't remember, just go back to our previous lesson, the previous class, and please refresh your memory. And I told you the classification of everything also too. I told you we talked about that too. And then what we also talked about is this principle of double entry, which is the foundation of accounting. Principle of double entry, that for every debit entry, there must be a corresponding credit entry. And for every debit entry, there must be a corresponding credit entry. So please note this. And I said you must identify two accounts that have been affected in a transaction. Two accounts that will be affected in a transaction. I told you all that. So please try and read that to understand. You have to know it very well. So it will help you to guide you in knowing accounts. Help you to be able to compete or to be able to analyze accounting. It's very important. So we talked about the books of original entries, whereby we talked about the sales book, purchase book, the cash book, the return word and outward and everything. So we talked about all those book of original entries. I told you the source documents, all those source stuff where you get all your information from, the document you get it from there you go straight to the journal, from journal you go straight to the ledger, from ledger it goes to your trial balance, and from your trial balance then it goes straight to your final account, which is profit and loss account and balance sheet. We talked about that. Ledger, we talked about ledger and everything, the use of ledger, how you post ledger and everything. So we spoke about trial balance also too, where we talked about check the arithmetic accuracy of your account to show that yes, the account is going to balance or not. So if you see that the credit side is not the same, the credit balance is not the same as the debit balance, then something is going wrong. Then there will be something that will be wrong. So that means there's something going on. But there are some situations whereby it will not even show. You will not even know. The debit side will be equal to the credit side, but you will not even know. And we told you those errors that will not affect our balance. Error of omission, error of commission, error of principal, error of double posting, and everything. We talked about that. Please go through it to know more and more and more about it. And we talked about reconciliation statement, that bank reconciliation statement, whereby we said sometimes you get your cash book, you see that at the end of the month or the year, most especially at the end of the month, you discover that your cash balance is not the same amount in your bank balance. So there must have been, something must have happened. So you have to reconcile, you have to align it. We talked about that, and we are going to do examples of that. So I gave it to format. If you want to walk back from cash book back to you want to walk back from your cash book balance to your bank balance, or vice versa, from your bank balance to your cash book balance. And do that. There's a format for there's a method for it, two methods which we talked about. Then where we ended last Saturday was on depreciation. We talked about depreciation, what depreciation really means when I was giving an example, depreciation, and I told you some methods of depreciation where we have straight line method, reducing balance method, some of the year-to-date method, others we will have machine hour method, So, that was where we stopped last Saturday. So today, I'll continue to my screen so we can continue from the. So today, we'll be looking at understanding Accra and fulfillment. Understanding Accra and fulfillment. Understanding Accra and fulfillment. So I hope you all can see my screen. So I hope you all can see my screen. Can see my screen, please? Can you please indicate from the chat box?
Yes, we can see your screen.
Thank you so much. So Accra and fulfillment. If you remember vividly from our last conversation, our last lesson, our last class, we talked about one of the principles of accounting when we talk about the Accra principle or the cash principle, the Accra basis or the cash basis. So that same Accra we're talking about is the same Accra we are talking here. So accruals and fulfillment, these are some of the transactions that will happen that will sometimes need their adjustments that you need while preparing your final account. You need them while preparing your final account. So based on accrual basis, you have to adjust some transactions. You have to do some calculations on some transactions whereby you're able to put it into that account as that period. So you cannot go beyond that period. So you're not recording future period into a current period. So this is why Accra and fulfillment is. So let's start Accra. This states that revenue and expenditure are recognized as they are earned or incurred. The last time I said, anytime you make a sale, even though you've not been paid, the cash has not come in as much as you make that sale, in as much as you won that contract, shows that it means that yes, you have to recognize it. Private companies, but it's only work with they don't work with Accra business, they work with cash business. Only when the money is earned that they recognize it as income to them. Only when money is earned in the government that when they recognize it as income. But in companies, the moment the revenue is earned, you earn that revenue, you record it, even though the money has not come in. Or the moment the expenditure has been incurred, you incur the expenses, but you not even pay. For example, those who are using postpaid, let's say estimated bill in your house, your estimated bill, at the end of the month, you now give it your bill. But at the beginning of the month, while from the beginning of the month to the middle of the month, you are already incurring the expenses, but you've not paid. So you recognize that I am owing this amount. So this is an accrual. So accrual, this is revenue and expenditure. So revenue are recognized as they are earned, and expenditure are also recognized as they are incurred. And dealt with in the profit and loss account for the period to which they relate, and not the period they are paid or received. Not the period they are paid, not until when you now pay that expenses, you now record it. No, you record it immediately you employ it, or you record it immediately you have earned it, not until you have received the money. It is accrual for it. And it's divided into two. We have the income part of the accrual and we have the expenditure part of the accrual. So the income part of the accrual, so these are income which are due in respect of the current trading period, but some income have not been received at the closing of the final account iteration. So for example, your rent, your rent receivable. No, you pay rent in a you pay rent, with commission receivable. So these are accrual income. Why accrued income rather? Why accrued expenditures? So these are also expenditures that these are expenditures which accrued but have not been discharged. You've already incurred the expenses, but you've not paid it. You've not paid it. Not paid it. That's why I said the postpaid. Those who are using postpaid meter in your house and everything. Postpaid. So if you have postpaid, so that's postpaid meter. So you already incur it. So if at the end of the month, you now pay for it. At the end of the month, you pay for it. At the end of the month, you give it. This is how much is extended. This is how much is extended. You can pay for it. The opposite of this accrual is called prepayment. From the word prepaid, even your meter, your meter at your house is prepaid. That means even your phone, you recharge, you prepaid, you paid, you make payment beforehand before you use it. Make payment. When we go to prepayment, what is prepayment? I can see. As you can see, this represents amount paid in current period for a subsequent period. Represent amount paid in current period for a subsequent period. Expenses can be paid in advance and income can be received in advance. Expenses can be paid in advance, also income too can be received in advance. When you pay your rent, you are paying in advance. You pay your rent to landlord, so you've already paid your rent in advance. You've already paid your rent in advance when you pay your rent, because it's not exhausted. So you pay for this all some of the their rent already paid January. Already paid for January to December. So they are paying 120,000 from January to December. That means as at today, you've already exhausted 10,000. That's only January. So you still have you've made a payment of 110,000. You already made a payment of 110,000. So the payment is your meter. When you go ahead and recharge, you give your token and you recharge your meter. So that any amount you so you've already paid in advance. So you need by little just to do start using it. So that's the payment. So also divided into two. You have expenses in advance. So these are expenses like rent in advance. Every landlord wants to collect rent in advance. You don't want any rent to be in a normal pay at the exact time you're supposed to pay. So it's no more payment already. So expenses in advance. These are expenses like rent. So insurance you pay is always in advance. Your electricity bill, if you pay is in advance. It's in advance. But estimated one is not in advance. That is now accrual because you've already extended it, but you've not paid. That is for accrual. But for prepayment, when you're using the prepayment, there's no way you have to pay in advance or else you'll be cut off from the electricity supply. So for example, we are paid in advance for subsequent period. Only expenses for the period would be charged to profit and loss account. So to explain this instance, only expenses for the period will be charged to profit and loss account. For example, you have an office and you run your accounting system from January to December. That's at the end of December to prepare your financial statement. And now let's say in June or let's say in July, you now paid let me look for one example. Okay, let's say you now paid for your electricity. Oh no, let me now use electricity. Okay, let me use electricity. You now pay an electricity bill. You paid your prepaid meter, you paid maintenance that will last you for a year. And you paid it in July. And that electricity you paid going to last you for a year. That means it's going to be from that July for that year to June the following year. So when you are preparing your account, you will not record the whole electricity expenses you made. You will not pay, let's say let's say it's 100,000 you made for the electricity. You only calculate for the 6 months of that current year you are making account with. So your electricity will just be for that 6 months, which is now going to be 50,000 naira. Then 50,000 naira is now your prepayment. Now be your prepayment. It will not be recorded in your profit and loss. You want
Excuse me, Mr. Samuel.
Yes.
Please, can you be a bit audible? Thank you.
Okay. Louder a little bit. So let me come again from the prepayment. So please, if you discover that I'm not audible enough, please always let me know. So I can always come back. So prepayment, as I've said, this represents amount paid in current period for a subsequent period. So the amount that you have paid, you paid for subsequent period. So expenses can be paid in advance and income also can be received in advance. When it comes to expenses, you pay in advance. And when it comes to income, you have received it in advance. So that's what we're talking about. And we said we have the expenses in advance and we have the income in advance. An example of the expenses in advance that we're talking about is your electricity bill, your prepaid meter, your rent, you pay in advance, your insurance, your motor vehicle insurance or maybe life insurance or any insurance you make those payments in advance. So that's what we talk about the payment. And when we now talk about income in advance, so these are income received during the current period but relate to the next trading period. So that means if you're a landlord and you receive rent, that means you receive that rent in advance. So if by tomorrow the tenant says, I'm no more using your house rent again, I want to leave. So the onus is on you to make sure you refund that person the remaining part of the month that is yet to use. So you have to return the amount back. It's very important because it is in advance. So you, when you see the rent in advance, the money is more or less like a liability in your hand. You cannot just say anyhow because the tenant can come at any time and say, can refund my money because I've not used so month in your house, so you can refund me. Except it's stated in the agreement, not refundable. So how does this affect the saving and loss account? That's where I want to go. As I have said, when you are running, for example, your trading account, your trading period is between January to December, 12 months, according to the principle of accounting we have. From January, if you are running your own account from January to December, and you make them, if you have made the electricity bill in January and you made it for 12 months, you paid it for 12 months, and it's going to start from January and it's going to be December, the same accounting period also fall within the same accounting period, then there's no problem. For the moment, it is now in between, in the middle of the period, maybe in June, let's say in July, for you have 6 months, you pay it in first July. And you have July, August, September, October, November, December, that's 6 months. But you pay for 12 months. And that's 6 months. You pay for 12 months. So what will you do in your account? When you are now preparing your account at the end of the year, in December, when you are preparing the account, you will not put the whole 12 months amount, which, for example, let's say let's say it's 100,000. If you not put the whole 100,000 in it, that might be the benefit for this or so years. No, you only calculate for the 6 months you exhausted. You put it there. The remaining 6 months, which is the 50,000 balance, will not be recorded in your profit and loss account. For that work, you now take it to your balance sheet as prepayment. You record it in your balance sheet as prepayment to be there as prepayment. So that in the following year, now you can now put it back in your trading profit and loss account, which falls within the period where you are now making your accounting statement. I hope I'm clear. I hope that is well understood. I hope that is well understood. I hope that is well understood. So, and lastly, the final account is where account really is. The final account. So when we're talking about the final account, we are talking about trading, profit and loss account, and balance sheet. The secondary school you must have had this, the ringing a bell today, ringing a bell today. They have your trading, profit and loss account, and your balance sheet. Trading, profit and loss account. You can see my network is somehow confusing. Don't know what's going on. So final accounts are the account prepared at the end of the accounting period to show the position of the business. Final account is the what? These are the accounts prepared at the end of the accounting period. Your own accounting period might be different for someone else's accounting period. Your own accounting period might be from June to May. That's 12 months. Or from July to June. Or from January to December. Or most of the time, most companies take it from January to December. So your final account. So let's now take it one by one. So the trading account. Trading account. So we have 3 accounts we were talking about here. We have the trading account, we have the profit and loss account, and we have the balance sheet. So we'll take it one by one, each of those accounts. Let's look at the trading account. So this is the account here for the purpose of finding gross profit or loss of a business at a particular period. If you want to know if you're making gross profit, I'm using the word gross profit, you get it from your trading account. And this only deal with goods, what you are selling, actually of what you are selling is what it is. Cost of the product, the sales of products, you want to know if you make profit or if you make loss. And this is why it is important to always have a record for you to know, am I making profit, am I making loss? Am I making profit, am I making loss? If you make profit, you know the thing you have to make. If you're making loss, you know the next step you have to take. So this is the account prepared for the purpose of finding the gross profit or loss of a business at a particular period. And this is what it contains. On the debit side, which is the left side, which is the left side, which is the right side. On the debit side, and so on the which is the left side rather. On the debit side, which is the left side, you have your opening stock. That opening stock means the stock you have, your goods you are selling, the one that you have on ground, the one you have as at 1st of January 19XX. The stock you have on ground. So if a malam is having a shop and still a cost, you now say, this 1st of January that we are now 1st of January 2020. Okay, are the stocks I have. You look at the stock, the receipt, and everything. You can't say, I have 10 of this, I have 5 of this, I have 20 of this ingum, I have 2 stacks of water. These are stock that are bringing to this new year to start another accounting period. So the opening stock. Then what next? You have your opportunity, that the stock you are buying also. What are the stocks you now bought in addition to the stock you had on ground? That's when you have purchases. You had purchases. You had the purchases in addition to the ones you have on ground. So what are the stocks now to go to market to buy? So that's why I have add net purchases. So net purchases means the purchases less return outward. Return outward means that if there are some stock that was supplied that you discover that it's faulty or you know what you ordered for, you have to remove it to know your net purchases. So you have the purchases, the stock you have on ground with one you bought and what the less closing stock, which is the purchases that at the end of the year, what are the purchases, what are the stock left on ground? Because it won't be the same. It won't be the same. So the purchases you have at the beginning of the year, 1st of January, and you had the purchases you've been doing during the period from January to December, all those purchases you made, you had it. And at the end of the month, at the end of the year, 31st December 1990 or 2000 so. Now take away stocks that's on ground. That will give you what? Stock of goods sold. That will let you know the stock of goods you have sold. I hope that is clear. That will let you to know stock of goods you have sold. Okay. That should increase the volume of mine. So I hope I'm audible enough to. I hope it's sorry, can you am I louder enough? Please let me know.
You are clear, sir.
Okay, good. So good. So this trading account we are talking about, that's not trading account. Stock you have as of January, 1st of January, stock you have on ground, all those materials you have on ground. And during the period from January, February, March, April, September, those ones you bought things, you have to remove those you returned that are not good, that is not what you ordered for. You add it to the opening stock. So opening stock plus your purchases will give you stock you have that is available for sale. I hope you are clear. The one you have on ground and the one you bought, to add them together, you get that stock that is available for sale. These are the ones that are available for you to sell. Now, at the end of the year, 1st December, I now look, I've sold this, I've sold that, I've sold that, and these are the ones left. So remove it. When you now remove it, the balance you have is the cost of goods you have sold. Cost of goods you have sold. So that cost of goods you have sold will now come on the credit side now, which is now your sales. This will now be your sales on the credit side and on the right side, sales. So those cost of goods that you have sold is now the sales. So how much do you now sell it? What is on the credit side? How much do you now sell it? You can't sell it at the same price you bought it. Who does business like that? You have to add something to it. So because of the increase, you have to add your profit to it. So at the end of it, so when you now balance it, you now see, okay, is it gross profit or is it gross loss? So you might not know. You're not keeping record. And you go and sell less the price. Less the price because your purchase is also, when you are purchasing it, you carry it in, your cost of transportation and everything is still there, which will have to be added to the purchases. You go and sell it less, you don't see like you're treating yourself. So on the credit side, you now have your sales. When you now sell it, that's why I put less in something because there are some sales you have made that customer has to return it. I don't like this. I don't like the way this one has expired, this and that. So you left it from the sales, you get your sales. So when you now limit it off, together, you look at the balance, the debit balance and the credit balance, you let you now know if you are making profit or if you are making loss. That's when you get your gross profit or gross loss. So the objective of trading account is to ascertain the gross profit, to let you know the gross profit or loss from the business transaction. The happiness of every businessman is to always make gross profit. That is happiness. So when you begin to make loss, you will definitely close your business. You just know that this business does not pay you. Then you go looking for another business that will make more money. Even if you are making profit, gross profit. How much profit am I making? It's not that much. You now want to let me look into another area whereby I will make enough profit. So the balance on the trading account is transferred to profit and loss account. That's what takes us to the next one. The balance of that trading account is gross profit. You now transfer it to your profit and loss account. This is where you now know your net profit. This one is for you to know, this trading account is for you to know your gross profit. Because there are still some expenses you still make during the course of business. So you now need to know your sorry, I'm trying to look. Okay. So you now need to know whether you are making profit, normal profit, your take-home profit, the one you put in your pocket. You see, on a lighter note, that yes, you can use the ones to form big boy of detail. So let's now go to the format for format for the trading account. You can see the format for the trading account from the side. We have the opening stock, which is the assets, add your purchases, and add it, let any return outward, any return you need to default, need to wrong order. So you let it from the purchases. After you let it, what you get is your cost of goods for sale. That's the cost of goods available for you to sell. These are the goods that's now available for you to sell. And at the end of the year, your closing stock, what are the ones left that do not sell? What are the ones left that do not sell? You know, after letting from the ones that is available for sale. So you now have your cost of goods sold. That's the cost of all the goods sold. So all those goods are now being sold. Now your sales. How much did you sell it? And then on outward. And at the end of it all, you know, it's gross profit. Every loss, anything that is negative, it's always in bracket. It's always in bracket. It's your gross profit, it's your loss. If it's a loss, if it's a liability, you always put it in bracket. So that it means minus. So you put it in bracket, that's minus. It means minus. And in bracket, you have to remove it. That's what it means. So that's the format for trading. Then profit and loss. After you've done your trading account, you now see that you made profit, gross profit. You are smiling that yes, you made these people in this business. But do not forget there are some expenses you'll be making. Some expenses you'll be making. I hope I'm not having network issues. I hope you are hearing me clearly.
Sometimes you come and go off.
Just typing one. Let me know if you are hearing me clearly. There's no network issues. Wow, okay. Let me change my mic file location. So, okay, let's continue. Profit and loss account. So as I said, that the gross profit, after making the gross profit, you transfer the gross profit to your profit and loss account. You transfer it to your profit and loss account. So what is profit and loss account? This is the account constructed by a business organization to put the net profit. Trading profit shows you the gross profit, while the profit and loss account shows you the net profit. Net profit. Net profit. The trading account shows you the gross, while the profit and loss account shows you the net. So those on the debit side, the expenses, all those expenses you've been talking about, your insurance, your rent, your wages, salary, and your electricity bills, you for the cost of the business, you make your rent, you pay rent, your electricity bill, transport, here and there, you do for marketing, you do also these are expenses. You have to remove it from the gross. No, truly give this business to you or not. So on the debit side, it shows the expenses is secured. And that's why that prepayment and accruals comes in, because you need to record expenses within that period you are making that accounting, preparing that financial account. So you know, if you have paid in advance to next year, just take the one that concerns the accounting period. That's what you record. The one you pay in the next year will go to your balance sheet. Just don't take it off before you make the payment. So you just take it to your balance sheet to get there. You get there. So as you have said, your profit and loss account is just a continuation of your trading account. It's just a continuation of your trading account. And here is the format for it. You can see that the gross profit on the credit side. So on the credit side, you can see that the gross profit is there, and also the expenses, salaries and wages, rent and rates, your motor vehicle expenses, your vehicle, you buy fuel and everything. All these things is incurred because you have to factor all these things in your business to know if you don't factor all these and you just stop at gross profit and you think you're making profit, then all these costs, where will you put it? It's on your own. It's on your own. So you have to factor all these ones to know your exact profit. Your office maintenance, to buy bulb, you get fans, you pay your AC, you have to be in your conducive environment, you want your AC for you to work fine and everything. It's advert for you to get more sales, you go online, you do all those adverts, you also you do postage and everything, and flyer to people to just, and this my product is so good. You travel from one place to another, electricity, your office, also some legal charges also you do, and all that general expenses and record. So you record, you factor this one thing, and at the end of it all, am I making net profit or am I making a net loss? You know that. So these are final accounts and accountants who will always be here. And this is what make it now make the management make an informed decision or a business decision. Know what way forward, to know what to plan ahead. And these are what the government or the tax authority need to know what to charge you on, the rate of tax to charge you on, and everything. And these are what the shareholders also will need for them to know what it is at stake for them, the thing that would be allotted to them to know if this business they put their money into is making profit or not. These are the final accounts they only want to see. This is what the investor wants to see, that I'm looking at the financial statement of this company is making profit, so I can invest more into it because I know if I can invest, I will get back my money. That's the thing they look at. That's the thing they look at. That's why some other people will go ahead to go and win the dresses. To go and win the dresses, they wait just to entice people to bring in their money. But that's why we have auditors. Always also check it to make sure that it's not with the dress. It's not just doctor it. Make sure that it's exactly how the business was run. That's what it was recorded. So, format for net, for profit and loss. Format for profit and loss. What's the purpose of trading profit and loss accounts? Is to show the profit of the organization. You know, it's asked just for you to show the profit of the organization. If they're telling me that that company, my company is making a lot of profit, it's making a lot of profit. Show me. Company is making profit. Show me. It's not just a word of mouth. Show me. Prove it to me. Through this financial statement. Stand by auditor. Yes. From what we've seen, you can see that these transactions, these accounts show a true and fair view. So it's for comparison with other years. You know, when you do for last year, you do for this year, you have to compare. Am I progressing or not? Set target for next year. By the next year, I will make maybe another 40% increase in gross profit, or 40% or 30% increase, or 50% increase in gross profit or net profit. Or in this specific area, I've spent a lot, so I need to reduce this expense in this area. So it's help in comparison from last year to this year. So you need to see your turnover of last year. You see, the turnover of last year, I made 100 million. And this year, I made 150 million. So next year, I'm going to make sure I shoot more, I go further, maybe to 200 million, 250 million. So we compare. And also for income tax assessment, the tax authority, they only want to see, to be able to assess you on tax, on withholding tax or capital, or capital, or those withholding tax of VAT or any tax related. They want to assess it. And for management purpose too. Management will always want to see the accounting, the financial account, for them to make decisions for the business, for the company, for the organization. Business decision for the organization. And balance sheet. Balance sheet. So, balance sheet. To the level I've explained, is it clear? Do you understand if I move to balance sheet? Is it clear before I go further? Just typing 5, that is the word I've explained. Just typing 5. Typing 5, it is clear. Where's my chat box? Okay. So it is at least if it's trading profit and loss, that trading profit and loss, if it's clear, please typing 5. Typing 5. Let me know if it's clear, because we're going to do example. We're going to work on example. So, and we are going to do it together. Typing 5. I'm not seeing anybody type. Or if it's not clear enough, let me know. Let me know. If it's not clear enough, let me know. You understand the trading profit and loss that we just talked about. Typing 5. Let me know. Let me know if you understood it. Let me know if you understood it. Let me know if you understood it. Is there anybody in the class? Or am I the only one? Am I the only one? Am I the only one? If there's any question, can someone just type in something? If you have any question, let me know. Or if it's well understood, let me know. If it's well understood, okay. Yes, Daniel, you are with me. Yes, okay. Is there any other person too? So it won't be okay, Abigail. Good. So please, I guess you understood at least to appreciating level, you understood the trading profit and loss. Before I move to balance sheet. So let's continue. Balance sheet. Balance sheet shows like a picture. Thank you, Mr. Sonny, thank you. Balance sheet is like a picture. When you take a picture, the position you have, that's what balance sheet shows. Trading profit and loss. The trading profit and loss account shows your daily transaction, every day transaction you make from January, February, every day, March, April, May, June, July, December. That's what the trading profit and loss shows. For balance sheet, just show snap. It's like a snap. Just snap. It just show the sort of the position. It just shows the position of your company. It shows the position of your company. That as at 31st December 1990 is the position of my company. This is how my company looks like. It's just like a picture. But the trading profit and loss account will always tell you what transpires, what occurs throughout the year on a daily basis. What occurs throughout the year on a daily basis. But balance sheet will only just show you as at the end of the year how the company looks like. The statement drawn up at the end of each financial year, setting forth the various assets. That balance sheet will show you your assets. Your assets as at the end of the year. All your assets, all the building you have, the amount, the motor vehicle, the amount, the plant and machinery, the amount. The liabilities to those you owe, those you owe, those you borrow loan from, if you show them that in balance sheet. It will also show your capital, that's the amount you are personally invested into the business. So the amount you have personally invested into the business, and it is well arranged. So we have the assets. We're all familiar with what assets is. We talked about assets. So these are resources, these are properties or your possessions of an organization. They are owned by the business and are expected to be of some future benefit. Expected to be of some future benefit. You only need to get money, to earn money into the business. These are the things that bring in money to the business. You make use of it for you to bring in money to the business. So assets is divided into fixed assets and current assets. Fixed assets and current assets. So fixed assets, these are your land and buildings. These are fixed assets. The furniture and fitting and plants and machinery. These are assets that are expected to last more than 1 year. That is expected to last more than your accounting period. They are expected to last more than 1 year. Than to use it beyond the accounting year you're making. They are fixed assets. They are long-lasting assets which are used for the purpose of creating productive capacity. They last more than 1 year. They last more than 1 year, and it's not made for sale. You bought it for to make sure the business progress, to create more productive capacity for the company. So they last more than 1 year. The land and building, the furniture, the fixing, the plant and machinery, the motor vehicles, these are assets. Now, the second type of asset is current assets. You see, have many other kind of assets, but let's just focus on fixed assets and current assets. So current assets are assets that will only last within 1 year. These are assets that are usually for a short period of time. They are only just for a short period of time within a year. That just within a year. Your cash is you. Cash is an asset, but it stands as current asset. It can only last within a year. Your goods, your stock, your closing stock, the closing stock you have is also an asset to you, but it only lasts just within a year. You don't expect it to begin to last more than a year. Your bank account, your treasury bill, when your treasury bill, the investment you make, and your treasury bill is about 3 months or 6 months thereabouts. Your debtors, those they are owing you, your bills receivable. These are current assets. Current assets. So you don't see the difference between fixed assets. These assets is expected to last more than 1 year. And they are the land and building and everything. And current assets is just within a short period, within a year. That's our current assets. Arrangement of assets in balance sheet. So there are ways you arrange it. You just don't arrange it anyhow. So we have the realization. You have the realizability in order of convertibility. That means the way you want to convert it. How easily can it be converted to cash? How easily can it be converted to cash? So that's 2 ways of arranging it. So that's why some people they start with the current assets. And the first, how easy can it be converted to cash? So that's why you have cash first, then your debtors, those who are owing you, and also begin to convert into cash, the company. Then your stock you have, also when you sell it, that's when it will be converted to cash. Then under fixed assets, you have your investment too. So your investment, when your investment mature, which of the investment can last more than 1 year, it can easily be converted to cash. The furniture and fitting is easy before motor, before plant and machinery and land and building. So that is what we call the realizability. But the most one that is permanent. So this is the one that after can be arranged in order of permanent. How permanent is it? Land can last forever till thy kingdom come. Land can last forever till thy kingdom come. Building can last for 50 years in as much as you structure it very well or more and everything. So you now come to plant and machinery, which also can still last a little longer. When it now comes to vehicle, a little less longer. It's now furniture and fitting, just small longer, which is now investment in a few longer. Then come to stock, current assets, stock, debtors, bank, and cash. You can see from how it lasts longer straight down to the one that can easily be converted into cash. So this is how and it is this permanence that we follow. This permanence that we follow. Liability. These are things you see in balance sheet. These are things you see in balance sheet. So liabilities. These are obligations arising from the past transactions. You all know what liability is. It's a claim by the outsiders. You know, when you borrow money from the outsiders, so it is a claim. It's a claim from the outsiders on the aspect of the business. Because you are not only using your money, you are not only using your money for the business, you borrow for other people's business, other people's money. As I give an example of Dangote, that apart from his business, his own personal money would have used for the refinery, that borrow other people's money. So if he's showing up his balance sheet for that business, clearly you will see liability there, creditor there. It will be creditor Nigeria as a country, because we borrowed him also. We have our own stake in that company too. One of us. So that claims by the outsider or the asset of the business. It is also the indebtedness of an organization to outsiders. So we call it DC. The company is owing outsiders. That's the debt the company is owing. So when we have loans, when you go ahead, you go and borrow loan from bank, you have to return it. For that loan, you have to put it there. This loan, I borrowed the loan. All these things will show in your balance sheet. Please take note of this. No transactions that will occur. All those transactions that will appear in balance sheet. Do not mix them together. Do not mix them together. When it comes to liability, like the debenture, the loan, the creditor, you don't record it in your profit and loss account. It will appear in your balance sheet under liability. So liability is divided into two. You have the long-term liability and the current liability. So the long-term liability, which are the debentures that last, debenture, loan, bonds that last for more than 1 year. So sometimes government will issue bonds. So you buy it, can last for 5 years. So they'll start paying interest. By the end of the 5th year, you get back your capital, your lump sum. That's having servicing for you and everything. So you get it back. So these are, and sometimes the ventures you get from a loan from bank also you pay interest monthly. The interest you're paying that will show in your profit and loss. For the lump sum you borrowed will show in your balance sheet under long-term liability. You have current liability. They are liability that become due for settlement within 1 year. Just like we have the current asset within 1 year, we have current liability just within 1 year. Just within 1 year. They are liability too, but they are in short term, your creditor when you make sales, those when you when you make sales, those are only they are your debtors. So those ones are your debtors. So that's under asset, current asset. So this time around, the money you borrowed, those you are need to pay back, your overdraft you make from bank, your accrued expenses also too. Those accrued expenses, which we talked about, so we appear in this place. We also appear here. So capital. So capital, we all know what capital is. Capital is the amount, the amount your own amount, your own money you are putting into the business. That's the original money invested in the business by the owner, or the equity. The amount you invested in the business. So talking about the capital. So it's also known as net worth or owner's equity or owner's equity. So balance sheet for you. Balance sheet for you. So let me recap again the profit and loss account. So for clear understanding. So let me come back again, looking at the time so that we're able to meet up the time. So the trading, as I've said, the trading profit and loss account. Your trading account, I have said that it shows your net profit, your gross profits rather. This is an account that is prepared for the purpose of knowing your gross profit or loss within a particular period. Within a particular period, that's out your 12-month period. Let you know your gross profit. You can see the format for it. You can see your opening stock, you had your purchases fee, then any return outward, you can take it off. So your opening stock, your stock you have on ground, when you now add it, that is the cost of goods available for sale. That's what we have, the cost of goods available for sales. And at the end of the year, the stock that is not yet sold, less it. If you're having your cost of goods sold, that's the cost of your goods that you have sold. So when you now make the sales, you need to have on the other side of the transaction, that's on the right side of it, your sales. So any return inward, they return any goods back to you, the customer. So you take it off from your sales. So when you have the balance for you to know your gross profit. And you transfer your gross profit to the net profit aspect. When I said the net profit is for you to know, after removing all expenses, for you to know your net level. You come to profit and loss, for you to now know your net profit. For you to know your net profit. So the profit and loss account is prepared for you to know your net profit. As you can see the format, after you've gotten your gross profit from what transpired between your purchases and sales, then you now have to take away all the expenses you've been making during the course of the business for you to know if actually you now make profit, net profit or loss. And at the end of it all, when you now make either profit or loss, this net profit will go to your balance sheet. You take this net profit to your balance sheet. As I said, that balance sheet shows the picture of the business. It shows like as at this social year, this is how my business look like. The asset, look at it, this is the amount, this is the creditors I'm owing, this is the profit I've made, these are people that are owing me, this is the cash I have in my house, this is the cash I have in my bank, this is the bank account I have, and everything. It shows everything. This is the loan I've borrowed, this is the amount I've invested in it, this is the amount I've borrowed from people that invested in it. That's what balance sheet shows. Balance sheet as so. In account shows the transaction between the first to the end of that period. To the end of that period. So also, as I said, take note of items that are in balance sheet and of items that are in profit and loss account. Debtors will not appear in your profit and loss account, but will appear in your balance sheet. Stock will appear in your profit and loss account, but the stock that will appear in your balance sheet will be the closing stock. It will be the closing stock, if not because that is what is left as at the end. The stock that is left as at the end of that period, that will be there. Also, the investment is made, the furniture, the state of the position of the operation after removing depreciation. When we talk about depreciation, after depreciating, so this is the amount left, this is the value of this, your motor vehicle, your plant and machinery, land and building. So it goes in your balance. So let's now go ahead to do some examples. Before going to the example, any question? Any question? Any question? Example. Any question? I want to believe you understood it all. I want to believe you understood it all. So just need 2 minutes to. Okay. So just give me 2 minutes to open the question so we can work on our. Sorry. Can you see my screen? I hope you can see my screen. Hello, can you see my screen? Okay, okay, all right, good. So I'm trying to share the page so that we can continue to work together. So if you are with your laptop, please, I would like you to follow along with me. I'll be asking questions, so ensure that you type something. Let's make it interactive. Let's make it an interactive section. So I think that will be better to make it an interactive section. Just hold on. In the meantime, just look, you can see from the following trial balance, you set the trading profit and loss account and balance sheet. So just take a look at it. Just take a good look at it. Okay. So can you see two screens showing? You are seeing the
Yes,
two.
we can. Yes, we can.
Good morning.
Samuel, are you still there? We can't hear you. Right, please let's give him a few more minutes. He's having a challenge with his network. We'll be joining back shortly.
Hello? Hello, can you hear me?
Yes, we can.
Yeah. um, Okay, okay. So let's look at time so we can able to meet up with time. All right. All right. So trading on something like this. Sorry for I'm trying to draw everything. So good. So let's start. I hope you've read at least something from there. So from the following trial balance, prepare trading profit and loss account and balance sheet as at 30th, as at 30 December 2023. You have your capital, you have your stock, that you have the stock here. Stock here is opening stock, carriage inward, drawing stock, carriage outward, return outward, creditors, purchases, rent, expenses, insurance, return inward, motor expenses, rentals, lighting, salaries and wages, cash at hand, motor vehicle furniture, office expenses, sales, and all you have on your debit side is the same thing you have on your credit side. That's 320,890,000. You have it in both balance. So which is so to say that yes, you can go ahead to do the building profit and loss account. Then we now have another additional information here that stock at close. Stock at close was 3,000 naira. The stock at close was 30,000 naira. So looking at these transactions, you need to know which transaction will come to the profit and loss and which transaction will come to balance sheet. First of all, capital. Where is capital going? Is it going to be profit and loss or balance sheet? I need to know. Profit and loss or balance sheet? Profit and loss or balance sheet? Capital. Where will it go? Is it someone's is it P&L? Is it trading P&L? Or is it going to go to balance sheet? Someone to start it on the chat room. I need to know. Where will capital be? Where are we going to record it? Where are we going to record it? Where will it go? Yes. I want to be as interactive as we've got this now calculation. So we need to be involved. We need to engage ourselves. We need to be involved. So I need to know that yes, we are all together. So capital, where is it going? As I've explained earlier before about the items that are going to capital, that are going to balance sheet, and the items that you see in profit and loss. So capital, someone wants to type, Abigail, where are you? Type something, let me know what's going, where will it be? Abigail, Daniel, where is everyone? So where will it be? And the rest. So where will capital be? Are you going to put it? Okay, yeah, okay, Peter, that's balance sheet. Good, yes, that's very good. Then stock, this stock we have here, closing stock is Abigail, thank you. The stock we have here, this is 23,680. Where do you think that will be posted? This is the opening stock. This is opening stock. No, this is opening stock. Where will it be? Where will it be? Where will it be? I don't know which one, Daniel, you are responding to. Is it the capital you're responding to or the stock? Now I'm talking about stock, this opening stock that I am highlighting. The opening stock, so where is it going? Is it balance sheet or capital? Good. The trading account. Thank you, Peter. Trading account, you are with me. Good. Purchases. Where will you post it? Is it trading account or balance sheet? Purchases. Is it trading account or balance sheet? Where will you post that? Purchases. Trading account or balance sheet? Where will you put that on? Trading account. Abigail, you only said account. Which account? Is it balance sheet account or trading account? Let's know which one exactly. Where is it going? No, not saving, no, trading account. So trading profit and loss account. Yeah, thank you. So good. So let's now start. At least you're following me. So we know what we're talking about. So we should know the items that will be in your trading account, and you know the items that will be in your profit and loss account, and you know the items that will be in your balance. capital. Capital item, we want to start with trading profit and loss account, so we cannot start with capital first of all. So based on our format, what do we have? We have, from our format, we have opening stock, isn't it? So we start with our opening stock. We start with our opening stock. To minimize this, so it won't cover my screen, but I need to do something. So we have our opening stock. Well, how much is our opening stock? We have 23,680. So we have 23,000. So after opening stock, what do we have next? What do we have next? There's someone to type on the board. You will be the one teaching me now. After opening stock, what do we have? What should be the next? As I've explained, so when you look at the stock you have in your rule, Peter, thank you, Peter. So you have your purchases. So that's what you have next. You had your purchases. How much is our purchases here? With our purchases, it's only going to be at the side. Thank you. So we have 118,40. So after purchases, what do we have next again? So as I said, when you make purchases, that means you purchase some items. So the moment you discover that some items are not good, what do? You return it. That's return outward. But before that, I can see carriage. You can see carriage here. So now I like it here. You can see carriage outward. You can see carriage outward, and you can see carriage inward. Carriage inward is always, you have to add this to your purchases, because as you purchase it, you need to carry it in. So it should be added to your purchases. You know what? It should be added to your purchases. So you have the carriage inward to it, because it is not only the amount you use to purchase, not only what you just count as your cost of purchase. Carry the amount you use also to carry in the transport you pay, or the advocate you pay to actually to carry it. Also, you add it to the cost also. So you have the carriage inward. I want to be highlighting the ones that we won't go back to it. So we know that yes, it's of this figure. Let me just put it in another color. So we know that we are not using it anymore. So let me just put it in. Let me put it in that color. Let me put it in that color. So we make use of stock, we make use of purchases, so we won't get confused of which one is not used. So we want to make use of carriage inward. So you have carriage inward also create carriage inward. Carriage inward. Let me create, I think I need to create another column here. So it's always differentiated. And that. My purchase here. All right, our carriage inward is 3,100 naira. That's our carriage. That's our carriage inward. So to add this together, we're having, where has all these? we have this as our purchases. So then we need to know, was any goods returned? Was any goods returned? That's what it means. Was any goods returned? You need to check return inward or return. With goods returned, that will be what returned outward. That will be returned outward. Return outward. So we have a return outward. Return outward, which is 2000. But it will be in minus because you have to remove it. It will be in minus. So made, we discover that some goods are not okay. We don't like it. It's not what we ordered for. So we need to remove it from the purchases. You have seen, we need to remove it from the purchases. So what do we now have? If we remove it from the purchases, what do we have? We have we now have 118,620. Just bring it down to this side. Just bring it down to this side. That's where we should be. Just bring it down to this. Just bring it down to this side. So with this now, this is what we have: cost of goods available for sale. We talked about adding your opening stock, adding your purchases. After we remove the one that we have returned, so we have copies of cost of goods available for sale. What we have. So one next is your closing stock. All we now have next is your closing stock. So what we have as a closing stock? Stock at close. Stock at close was 30,000 naira. Stock at close was 30,000 naira. So we have to put it there. Closing stock. Closing stock. Now have what? 30, because you are remember you are lessing it. So just don't go and hide again. Don't go and hide and lessing it. So from your laptop, if you just put minus before you, what's how much? 30,000 naira. And oh, sorry, I've not added I've not added this open stock and purchases. I've not added it. Plus this, I need to add it. What is it? So 23,680 plus that we have the cost of goods available for sale. So we have 142,300. 142,300. That's what we have right now. That's our cost of goods. That's our that one will give us this is exactly this one will give us cost of goods available for sale rather that I'm saying. This one will give us cost of goods available for sale. This one will give us cost of goods available. So that's your purchases and your opening stock together. We've added it to 23,680 plus these purchases after considering the carriage inward. After considering the carriage inward and letting the return outward. So we have this, add it together, we have your cost of goods available for sale. The next is what reflects your clothing stock on Naira. 1,000 naira. So when you get your clothing stock, 30,000 naira. Or we have one two 300. Have your 1 2 300. So that is our cost of goods sold. That's our cost of goods sold. That's our cost. So we now need to know our gross profit. Before we can know our gross profit, we need to know what our sales is. So before we can know our gross profit, what is now our sales? So what is our sales? Sales. What is our sales? Our sales is 176,000. Our sales is 176,000. 176,000. I need to reduce my phone. I think it's too large for me to move around. $176,000. So from sales to when you make sales, there are sometimes that you return part of the item. My return part of the item. My return it. So if you return it, that means they are returning it to you. That is return inward. Return inward. Is there return inward in there? So that return out, yes, return outward, we make use of return outward. So let me just highlight that so that we won't get confused. So let me just highlight it so that one can go. Return outward. So return inward. And yes, return inward, yes. That I just highlighted here now. Return inward. So which is 2,000. You have to remove it. Return inward. Let's return inward. Oh, 2,000.
Collier, share your music, share your love.
Which is 2015 naira. So would you let it? So then, what's now the difference? When you let it from your sales, what do we get? What do we get? What do we get? We get 173,960. 173,960. So this is our total. I think this is our sales, which we can say our turnover. We can bring it down. Okay. Here. So later we can now bring it down here. So 173,009. But we need to balance it from here to 173,009. 173,009. So balance it. Balance it. What will now be our gross profit? So if you are having 122, which 122, 122, which is cost of goods sold. Cost of 112,000. That's the cost of goods sold. But that cost of goods sold, we're able to sell it 173. The cost is 112. But we now made it, that was the cost. But when we now make the sale, we realize 173. That means there's a profit. That means there's a profit. So if there's a profit, so what will now be our gross profit? That will be the difference between this 173 and 120, 112. So I see 173, that's 173,950 minus this 112,300. So which is about 61,060. That is our gross profit. That is our gross profit. I hope at this juncture you are clear. I hope at this juncture you are clear. If you are not clear, please let me know before we move to the profit and loss. This is the hidden aspect of it. If you are not clear, please let me know so we can move to the profit and loss of it. If you are clear, if you are not clear, can you just type in 0 if you are not clear? Type in 0 if you are not clear so I can. Type in 0 if you are not clear. Type in 0. Because no, that means I want to believe you all understood. So as you have seen, our opening stock, the amount which is there. Our purchases, from our purchases, we have to add the carrying word to the fees. We have to add it together with it. That's why we have our 122. And the ones that we returned is 322, so which gives us 118. So that 118, we add it to our opening stock. So when we add it to our 118, we get our 143, which is the cost of goods that is available for sales. And at the end of the year, we're able to remove our closing stock. We're able to remove our closing stock. You can see we're able to remove the closing stock, the stock that was left, which is 30,000 naira. After removing it, we're able to have what is left is our cost of goods sold. That is the cost of those goods that we sold. That was the cost. That was the amount we bought those goods. That was the amount we bought those goods. That's why the cost of goods. So that's the amount we bought those goods. When you make those goods, when you sold those goods, this one, which is the cost. When you now make the sales, you realize you're supposed to have realized 176,000, but you discover that some of the customers returned some goods, which is 2,050 naira, and your turnover is now 173. So 173 and 160 is your gross profit, which will now be gross. You transfer it to your P&L. So you now want to do the P&L. Now want to do the P&L gross profit brought down. And 160. So go on. 160. Now we're done with the trading, and let's go to the profit and loss account. So let's go to the profit and loss account. So let's from the beginning again. Capital, we're not recording capital because we know this the balance sheet item. Carriage inward. Have we made use of carriage inward? Have we made use of carriage inward? Yes or no? Have we made use of carriage inward? Carriage inward is already 310. So let me just highlight it. So you don't get confused. Okay. All right. So make use of carriage inward. Drawing. Yeah. So what about drawing too? That is also a balance sheet item also. Therefore, the balance sheet item. Carried outward. Is it balance sheet item or profit and loss item? Is it balance sheet item or P&L item? Fund. Our carried outward. Balance sheet item or P&L item. Yes. I need response. I need response. Carried outward. Is it balance sheet item or P&L item? carried outward. So if I can explain carried outward, in case you don't know, that means when you make your sales, you transport it to your customer. You transport the sales, you transport it to your customer. So that is carried outward as you are able to deliver your goods, the cost you expended in ensuring that those goods get to your customer is carried outward. P&L account, is it P&L item or a balance sheet item? Good. We are done with trading, so you can see it's P&L item. So you are right. I think that. So you're right. So let's go on. So it's P&L item. So let's start. So we can just have our expenses. Expenses. Hold on the line. So carry outward. How much? We have carried outward 2,000. So creditor. Life put creditor. Yes or no? Life put creditor. Yes or no? Life put creditor. Yes or no? Okay, Peter say no. Somebody else talk. Anybody else against life put creditor? Yes or no? I don't want to buy Peters like that. So I don't want to follow. I want to follow somebody else again. Okay. Peter, have you? So that is that's your opinion. Any other person? Any other? Life put creditor. Yes or no? Life put creditor. I tell is an article creditor. I don't know your name. Is right? Your name is Itel, please for 15. Life creditor, yes or no? I need another third person. So we have no one. The third person will let me know where we are going. If I say no, Itel say yes. So we have balance. I need one more person. Life creditor, yes or no? Life creditor. Okay. So Daniel says no. Okay, no. So no carries the gate. No creditor is the balance sheet. You must know the items that are supposed to be profit and loss and balance sheet. So creditor will not be there. I give all those who answered you terms of every one of you items. So creditor will not go. Rent. What about rent? What about rent? Liable rent. Liable rent. No. Liable rent. Yes or no? Liable rent. Yes or no? So under expenses. Under expenses. Yes, thank you. Rent will be there. 780. One next general expenses. General expenses. That one's already for himself. General expenses. So I don't need to ask you that. But last you did that I need to put it there. Trying to take permission before I can put it there. But when he's already telling me that you put it, the general expenses is already telling me, put me. You can see my name. My name is already showing that you put me. Put me. So general expenses is the general. I like all these ones so that we know that we need to do it all. Multiple expenses. Let me add this one now. That was multiple expenses. That was multiple expenses. I need 3 answers before I can type anything. Okay. Peter said yes. Ajibala said yes. One more person to counter or to align with life with multiple expenses. Right? One more person, please. Someone to respond. So I can take my judgment. Yes. And life food doesn't have to do with the business. I don't understand what you mean by life food. But I just need your yes or no. So thank you. So motor expenses has to be there. Note, motor expenses is different from motor vehicle. Motor expenses is different from motor vehicle. Motor vehicle is the vehicle as a whole, which will go to your balance, sheet for. We are talking about motor expenses. Expenses. Okay. Good. Good. So you right, okay, that's good, Daniel. So you know what? Yes. Motor expenses. How much is our motor expenses? 180. That's our motor expenses. What next? Premises. You go. Premises. What about premises? So though Daniel told me lightning, okay, said no. Peter said no. The premises is not going. Premises is the balance sheet item. So what next? I like these motor expenses. So we know it down is gone. So lightning. 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 So we have 6, 4, 6, 6, 1, 2. After that, we have salaries and wages. All those two are salaries and wages. Salaries and wages. How much is salaries and wages? 1,000. Let me like those which we have used. Lighting, salary and wages. 1,000. Cash at bank. Will I record it? Will it be here? Will it be under this expenses sheet? Cash at bank. Peter. Yes, Peter. Anybody else? Anybody else? Anybody else? Okay. Good. So cash will be at the balance sheet. The balance sheet item. The balance sheet item. Good, good, good. So no need to record it. So now we have motor vehicle, which is also a balance sheet item. Furniture and fitting is also a balance sheet item. Then last one, which is what office expenses, will now be office 1,000. So it makes use of all the expenses. So it's not that item that was left behind, not that item that was left behind. So please note that this closing stock, even though it appeared in your trading account, but we left it, we've removed it. So that's why it's also going to show in your balance sheet. You now go and add it. Now go and add it there. So it will show in your profit in your trading account, which is already made to remove, but it has to now go and show in your balance sheet that the position of my company, this is what I have left at the end of the year. They are sending people. I have 20,000. So after Christmas, they sold chicken and everything. I'm only left with maybe 7 chicken in my garage to sell as at the end of the year. So that is what we are looking forward to 2024. And now start buying maybe the chick, the egg, now start growing, now get layers, get growing that, and then now start selling. So understand how it goes. So let's sum the expenses together. So let's sum the expenses together. So we have okay, the total sum here. Let me first of all just do the total sum. Where is it? Well, okay, the total sum here is 84,280, which is not up to the gross profit. So if you're having all the expenses, it's 84,280, and we're having gross profit of 61,050. It means we've made another profit. This is our net profit. This is our net profit. Let me write this one somewhere. So I won't get confused. 4,000. So our net profit, our net profit, our net profit will be what? It's our gross profit minus all the total expenses, which is 34,000. So we are having net profit of 27,000. So we are having this amount. That is the total. That will give you 4. Okay, you're saying no. Okay. Let's look at it. Okay. So that will be our that should be our net profit, 1,050. We have to start. If there's something else is not recorded, let me know. We have our, let me look at everything again. We are not making any error. We are not making any error. Oh, there's one who's not recorded. Insurance. So that's why one has to be very careful. One has to be very careful. We didn't record insurance. I just went ahead to highlight it. But not recorded it. Insurance. Not recorded insurance. That's what be very careful to make sure that we are not leaving anything behind. Insurance is not there. Insurance is not there. So insurance is there after that, so after the general expenses to come and just shift this one down with it. Okay. So we have a insurance. Insurance is 3,140. 3,140. So if you're having 3,140, I hope you're not missing any other thing. So that's the main thing, that we won't miss something. So we won't miss any other thing. Lightning is there, salaries and wages is there, office expenses is there. Good. So something of all this is 37,420. 37,420. 37,420. That's what we're having. 37,420. So our net profit will now be difference between gross profit and total expenses. This is our gross profit is 61,650 minus the total of all the expenses is 37,420. So we are having like 24,220. 24,220. That is our gross profit. That's our gross profit. So sum it up. So it balance with the gross. It's 160. Close it. Close it. It's 160. 160. 1. So this will go to your balance sheet. Remember, this will go to your balance sheet. Just made this also topic for this year. Any question at this level? Any question at this level? Any question at this level? Any question? Is there anything you don't understand? Let me know, please. At this level, is there anything you don't understand? Let me know. So we now move to balance sheet. Okay, I believe that after this lecture, you is there a question you are asking, or I don't get it? Said you have explained about this balance sheet. I don't get your question correctly. I don't know exactly what you are asking. Said after this lecture, you have explained. So can you let me understand? Can you be more clearer? So what? So balance sheet. Let's go to balance sheet. Let's do balance sheet of this thing. Okay, let me explain again. Let me explain carriage outward. So carriage outward and carriage inward. Now let me go back to the purchases. When you make purchase, when you buy goods, honestly, you went to market. You want to purchase some item that you want to sell. You bought it in large quantity. You know you can't carry it on your head. You don't want to carry it on your head. So you have to employ all this man that has wheelbarrow, or you hire a truck, or thereabouts, or you hire a bus, or you rent Uber thereabouts. So carrying that goods to your business, to your house, to your shop, bringing the goods from the market to yourself, the cost of that cost is made. The cost is given the aboki, the man with the wheelbarrow, or the one you pay the driver that helps you to transport it to your shop or to your company or to your house or to you from the market. That cost is called carriage inward, and it should be added to your purchases. It should be added to your purchases because it's part of what you use to purchase. So that's what we call carriage inward. Carriage inward. It should be added to your purchases. So that's why I add it to your purchases. So when you are saying you bought this thing, you must not say you bought it at 5 naira. You have to put 5 naira plus the 1 naira you used to carry it. You say it is 6 naira. That's the cost of it. You get. That will now be the cost of it. So if you bought something 5 naira and use 1 naira to transport it to yourself, the cost of that goods is now 6 naira. That's the cost, not the selling price. So we're not talking about the selling price. The cost price will now be the amount you need to buy it and the amount you expended in bringing that goods to where it's supposed to be. That is carriage inward. Carriage outward, on the other hand, is when you now transport those goods to your customer. It's an expense to you. It's not especially when you are the one paying. When you are the one paying. So one of the customers now called you, please, can you send me some of your items? Can you bring it to my house thereabouts? And you gave it to what do you call this biker? All these boats, biker or thereabouts, all these logistics. And they help you to transport that goods to your customer. That cost is carried. Okay. So that cost is your carriage outward. So it's an expensive fee that you have incurred. So that is why you have it under expenses as carriage outward. Honestly, I hope that is clear. So carriage outward will be under expenses under P&L account. while carriage inward will be under trading account added to your purchases. To be added.
Sorry.
Be added to your purchases. So just note that. So I hope that is clear enough. So let's move to balance sheet. Let's quickly move to balance sheet. I'm trying to look at the time, so we won't exceed time for break and all of that things. Balance sheet. So in as much, so balance sheet will now be very easy. Just look at the format for balance sheet that we have done. Look at the format. So we have as a what is it? So when you are writing exams, all these things they look at it. You have to put the main title of it. You have to put the Mr. Lagbaja, you put the Mr. Lagbaja, then trading profit and loss account for the year index. I'll go back and put down one there. So it's not to balance sheet. So balance sheet as at 30th. 30th December. Okay. So balance sheet is always as at 30th December. So as at that last day of the year. The trading profit and loss account for the year ended. I have too much on my screen. I need to be moving around there. Yeah, that's it. So it's not going to be the test. But let's just put it number. So let's now do our balance sheet. Let's move to our balance sheet. So on this side we have our assets. That's our this side will be our assets, and this side will be our capital liability. So it depends on the format you want to use. Depends on the format you want to use. So let's go with this format. So assets. Capital is fixed assets. Yes or no? Yes or no? Capital is fixed assets. Yes or no? Okay. No. So make doctor carry drawing debtor. Debtor is an asset, but not under fixed asset. But let's look at fixed assets. Fixed assets are the land and building, the motor vehicle, this and that. So see premises. I think this is the first one we saw now. Premises. So premises. So we have 6,000 premises. Because I like it, so I want them complete. So what else do we have? Cash and bank, not yet. Motor vehicle. So remember, you have to arrange them according to their permanence. So motor vehicle will come next. Motor vehicle. It was 41,000. 41,000. So like that too. Then we use furniture and fitting. Furniture and fitting next. Furniture. Thousand. What else? No other fixed assets. No other fixed assets. There's no other fixed assets. And let's sum up these fixed assets. We have 51,120. 51,120. That is the sum of our fixed assets. Then current assets. Current assets. So our current assets, do not forget our stock must show. Do not forget our stock must be there. Do not forget our stock, closing stock, not opening stock. The closing stock, the stock that was left at the end of the year, that is left that is not yet been sold. So we have to take your balance sheet. Stock, 50,000. Let me put this one here. 1,000. Let me put that one here. So we have our cash, and let me start from the top, so we know we don't miss anything. Drawing, debtors. Debtors is an asset. Those that are owing us, those we sold goods to. No. Peter. So no. According to permanence, when you have furniture cannot last as long as motor vehicle. So that's why it has to be. That's why it's according to permanence. That's why it starts with land. Land can last forever till Jesus comes. The last. Then what next? This one will now come next. That will last. Easily. Last thing. If you did it very well, if it was the right structure, if you did the right way. Sorry, hold on. If you did it the right way, you think it will last. Yes. So thereafter, then your plants, if you go to factories, all those are plants, or maybe you have sometimes when you even have generators or thereabout. Generators, so all those machines they use at the factory, those machines they use in producing, that one will even last again too. Before we now come to vehicle, especially when you don't have good roads, vehicle can last 5 years, especially when you don't even know how to maintain vehicle. Maybe 3 years or thereabouts. Before you now come to furniture at the office. So furniture at the office, sometimes it doesn't really last that long, maybe 3 years or thereabouts. By so forth. Generally speaking, motor vehicle comes when furniture and fittings. Now on your furniture, the fittings, the windows, the window blinds, and everything. So that's what we're talking about. That's what we're talking about. So stock, not stock. I said stock. Yes, that's where I was. That was where I was. Just stock. Trying to clear my screen to know see what it said. Not my side. So our data debtors are those who make the full history that they are yet to pay. They are yet to pay 6,009 creditor, not yet. Cash at bank. Cash at bank, 4,000. Cash at bank, 4,008. 4,800. So that's all. So what's the total sum? What's the total sum of this? We have 73,780. Bring it down on that here. So 73,000. So the total assets now, the total assets, this is the fixed asset and the current asset. Let's not total. That will be this 2,120 plus the current asset of 73,780. So we have a total of 155,900. 155,900 for the total asset. For the total asset. For the total asset, 155,900. So let's come to the other part of the balance sheet that now shows the capital and the liabilities. So just to post the rest that are yet. So the rest that are yet to be naira sign. So what else do we have? Capital. Capital. One, that's what we have. After capital, what the company is your net profit. Your net profit. Do not forget the result of your the result, the result from your trading account, which is gross profit, goes to your net profit. And the result from your net profit, the result goes to your the result from the trading account, which is your gross profit, goes to your profit and loss account. And the result from the profit and loss account, which is your net profit, goes to your balance sheet. Our net profit. When I printed in this orange color, our net profit, which is this, we have 24,320. 24,320. That's our net profit. Sum it up. Let's just add drawings. Drawings, you have to remove drawings because we do it for personal use. So we want to know the amount to use to remove. You have 12,000. So minus the that we are removing it. So that's what we have in this case for this side. So let's now add everything, all this together. Let's shift this inside. Let's shift here. Person, have this design. We have our 168,590, 168,590. Let's now come to our current liability. Current, we don't have long term, we don't have loan, we don't have debenture, we have loan, we have debenture, we just put long term liabilities, then we'll put it there, long term liabilities. We have to remove drawings because the June, so we have to remove from net profit, So all what we have left, let's talk drawings, then what else? Only creditor that is left. Only creditor that is left. Correct ability. I have your creditor. One, 2,000. So, okay. Okay, Peter, drawings, if you remember our last lecture, when we were talking about principle of double entry, I talked about when the business holder try to withdraw money for personal use, so for private use. When you do it for private use, that's what we call drawings. And put extra so that it can be like drawing that you are sketching something. So drawings, when you do something for money for private use, for personal use, you have to deduct it from it. Drawings. Sometimes some people will always put the drawings under the expenses here too. So when you put it under the expenses, you know it will reduce the net profit here. So when it reduces the net profit here, so when you put the net profit here, it's going to balance. But sometimes it's always useful in the bank statement for you to know that the bank statement, the balance sheet, for people to know that this is what was withdrawn for private use. This is what was withdrawn for private use. So let's sum up this together. So this 138,590 plus 17,310. So you now have the same 1,559,500. 1,559,500. So that is the balance sheet. So it has to balance what is there has to be the same thing. So Abigail, so is the diagram. I don't get what you are trying to say. And the diagram. Don't really understand what you're trying to say. So, but if actually I have idea what you are saying. This format here, the format we use here, you have this asset at the left side, and we have the capital and liability at the right side. I'm looking at the time. So, or sometimes you can do it in vertical format, whereas you have your assets as you have seen, all this capital, current and everything, it just come down. So sometimes when you check, it just come down. So either it just come down here, as you have your fixed assets on top, your capital will come underneath. So it depends on what you want. One thing that is much more important is that you have to, all the figures must correct and it has to be balanced and everything. So you can put it down to have a vertical format of it. So you put it down, it's also the same thing. So when you put your fixed assets first, then the capital and the current and everything comes down. So also you get the same balance. Also get the same balance. If I do it in this way, fine. And I can also bring it down here, which is normally the general way. If you take all financial statements, this is how you will see it. So this one can come here like this. So the fixed assets must be equal. Look at our accounting equation. We talked about that day. That's your asset. Must be equal to your capital. And assets must be equal to your capital and liability. So see your assets. As you can see, the assets, fixed assets and current assets. All your assets is 155,900. It must be equal to your capital. Your capital also comprises of the net profit and everything, and your liability, which is 17,000. Liability. Sorry. Liability. Any question? Any question as regard the final account? That's the trading, profit, and loss and the balance sheet. Including the profit and loss and the balance. Any question? Any question after that? Any question? So if there is no question, I would like to go back from the video lecture that was shared with you. So the place we talked about the double entry. I don't know if you all understood that double entry very well. Okay. In the situation where it doesn't balance, then you must go back and know what's going on. You must go back and know what's going on. But one thing that you must know that if from your trial balance, you will have known that there's something wrong. From your trial balance, just go back, trace it back, trace it back. Sometimes it might be maybe your calculation wasn't right, but sometimes maybe there's the wrong figure you put in. You must have placed the wrong figure. That's why we said sometimes it can be some errors that even if it's error that doesn't affect trial balance, it will still be balanced, but just that it's not showing the account will not show the true and fair about. So, but you just trace it back, go back to your trial balance, go back to your ledger. There must have been something that's wrong. There must have been something that's wrong. So, look at, can you teach us how we can use Excel in doing calculations like sum, total, and frequency? That is another different. That is another different. How would I say? I don't know how to put it. That's another different game. But it's so simple. There are some easy things you can know in Excel. Excel is very good when it comes to calculations. You should be able to know it. Actually, all these application and everything. So, but if I should now start telling you this now, it takes me off what I'm supposed to teach. It takes me off what I'm supposed to teach. But from your Excel sheet, you'll have seen, if you want to sum it up, just make sure you highlight. For example, if I want to sum up this total stock. Okay, sorry. So can you teach us how we can use Excel in calculations like sum total? And this total, like this sum total. You want to sum this total, just highlight it. And you come to make sure you highlight it. You give one room, one space. That's where the answer will be. Come to the top. You see also sum. You have it there. Even if you look at the arrow there, you see average. If you want to, if it's average you want, you are doing statistics or economics. You want average, you show you want everything is there. If there's nothing you want that you not see in Excel. So just come to auto sum. Sum it up. You can see 173,000. 173,000. That's the sum of all the things. That's what it will give you. And if you just want to sum up, maybe you want to sum up stock and cash alone. You want to sum up sum and cash alone. So all these cells, they are very important. On the cell, you can see so all those numbers you are seeing at this side, they are very important. All these aspects you are seeing on the top, they have meanings. So I want to sum up only stock and cash alone. I want to sum it up alone. I need the figure of only stock and cash alone. What will I just come? First thing is equals to, that's what it do first, equals to. Whether I click on it, this is just 634, or I type it myself. Loss cash, which is C36. Whether I click on it or I type on it and hit enter key, give you the answer. And that's how you do it. And it's minus 2, just click on minus. So that's just what you do. So please, you need the knowledge of the Excel for calculations and the arrangement of current liability. I just told you about the calculation of for Excel. So it's a different thing that's to take our time. So it's not part of the course, but I want to show you what I'm doing based on my Excel sheet here and everything. So when you just type in there, then for it to have, if you type in and you want it to, okay, let me give an example. You type it, go, let's say 2,000, see what you just, no comma, no double, another digit. Just come to the top angle there, you see comma, just click on the comma. There's a comma here, click on it. If you give the comma, so you'll be able to know exactly what you want to do. So that's just it. So, and then the arrangement of current liability, fixed assets, and other arrangements. So I told you how you can arrange your fixed assets. But it's always good to arrange it according to their permanence. And also current liability too, according to how they last, according to the year, according to how they will last. For example, that's why you have current long term will come first. If you have long term, let me do this. So if you have loan, you have the venture. Loan will not come here. The venture will not come here. It will not come after current liability, but it will come before. It come here. Long term liability. Long-term liability, that's where we come there. And after the loan, LOAN, the next one, the venture, the next one, and everything. So when you now come to current liability, that's the thing, those liabilities beginning here. You have your creditor, you have your overdraft, and thereabouts. So that is where you now have your liabilities. That's where you have your liability. Yeah, that's where you now have those ones. So that's how you do it. So you say principal won't mind. Don't worry, our principal won't mind. I don't understand what you mean. Your principal won't mind. So for the trading profit and loss balance, can we use our format? What format is that? I don't know what format you're talking about. When you say can we use our format? If you have the format, I don't know what the format you are talking about. So it depends on the format you are talking about. Except I see the format or what is more important in everything we do are the figures and so that the record shows that even if management sees, they understand clearly what you have done. It's only ambiguous. You don't understand what that. Let it be clearer enough that even the deaf will understand. I will not say even the blind because they cannot see. I will not say even the blind can understand. But I think even the deaf or the dumb can understand when you present it to them. So make it so that they will understand and you can make decisions concerning it. Can also make decisions concerning it. So Daniel, you said principal woman, no, don't worry, our principal. Is it principal of double entry or principal in your school woman? So let the principal that needs to talk, not you. You won't be the one to say your principal woman. Let the principal say, woman, please, how do you have two? Oh my God. How do I have two windows? Okay. No knowledge. Okay. In that you won't mind the extra knowledge. Okay. Somebody just okay. So I the screen to so when you hold your screen, when you open the app, when you open, for example, when you open the result at the top of it, just click and hold, drag it to the end, either left side or the right side of your screen. If you drag it to the place, it will give you like a shadow half screen, telling you that if you drag it to that place, it will be divided into two. So immediately message is divided into two. All other applications is open. We now show at the other side that you can actually now see the two at the same time. Now see the two at the same time. So this is just how it is. So you open your Word, you open your Excel, you open your PDF, you open anything. When you open it at the top where the color, each application has its own color. So when you hold it, at least one I know, you hold it, I don't know what you can see as I'm doing it on my screen, from the top arrow there, you hold and press and you drag it, drag it to the left side of the screen. You drag it there, you have seen that kind of a shadow or negative or that translucent way. So you drag it there, and when you drag it there, it becomes half. So it gives you opportunity to open another window. So you can see it makes it easy for you to begin to work with two windows or even the same windows trying to work and make it faster. So any other question as regards this account? So okay, in the 2 minutes we have, I really want us to look at the last time we talked about depreciation, and we're supposed to make some examples or some of the depreciation. Some of the depreciation, like for example, when we have the straight line method of depreciation and the receiving balance of depreciation, we supposed to at least use some examples concerning that before our time runs out. So we need to do that. We need to do that for the 20 minutes that we have. I just have to start typing the question now for us to know because other examples that we now have to do, it's open to now read further, look at it when it comes to when you now pay your depreciation, when you get your depreciation comes to your P&L account and expenses. P&L account, it comes there. So you write it there as depreciation, the exact amount of depreciation. Then when it now comes to your balance sheet, it will now be the cost of the item less depreciation. The cost of the item less depreciation. That is what we will now say. The cost of the item less depreciation. So the cost of the item as at the beginning of the year, less depreciation for the year, what we now put there. For the depreciation amount itself will be in your expenses. It will be in your expenses. So how to now calculate the depreciation? Another talk about. Another thing we need to talk about. Let's look at one example. That is for this like the straight line method. Method we about that is what we are going to look at before we go on break. I just want to give an example. For an example. So an example now. Example. So we have the cost of the motor vehicle. Cost of the motor vehicle is 3,000 naira. Grab value is estimated as 200 naira. As 200 naira. While price to use the straight line method to clear. I'll get back to you on that honestly. I'll get back to you on that. There's no problem. So you can send us the PDF format so that we can practice it. Yes, obviously. I can send that. There's no problem about that. No worries. So let's look at this question. Let's look at this question. The straight line method. So I used to remember vividly when we talked about this straight line method. So we said the cost of a motor vehicle is 3,000 naira. That's the cost of it. And describe value. That means if you want to dispose it off, you are going to dispose it at an amount of 200 naira, while the estimated useful life of that vehicle will be 4 years. It will be 4 years. So using a straight line method, we get the account. So what will now be the decision for each year? Year 1, year 2, year 3, year 4. So sometimes there's always math also in accounting. So there's always math in accounting. So let's do the math first. So normally, you know that there's a format for it. You always have cost. The format of the time method is cost minus capital value divided by what limited for life. Limited is 2 life. Cost minus scrap value over estimated is 2 life. So cost minus scrap value over estimated is life. What do we have? So what's the cost? Minus what's the scrap value? It's 200 naira. The estimated useful life is 4. You know, it's 4. And this one is showing 0, 4.00. I can remove the 0 by removing the comma. That, you know. So what do we have? 3,000 minus 2,000 minus 200. We have 2,200. That's what we have. So 2,800 divided by 4. Divided by 4 years. So at the end of the year, we're having 700 naira. So it's already giving me the answer. It's already giving me the answer. 2,800 divided by 4. So 700. So we have 700. That is for each year. Let's see that result. For each year. Year 1, because it's straight line method. So every year you'll be taking out 700. Every year you'll be taking out 700. Every year you'll be taking out 700. So how will the account now look like? How will the account now look like? So you have your motor vehicle account. Motor vehicle account. So So motor vehicle. So let's start with every year, and it's 4 years that we have 4 years. So let's have a year one. Year, okay, year one. So what was the cost of the motor vehicle? So you can say let's say you bought it cash. Let's use cash. Cash, let's cash. Or let's just use balance. Balance brought down. That's because of the beginning of the year. Beginning of the year was 3,000. That's what we have, 3,000. So the situation comes here. Year one, at the end of the year, that the situation is 700 comes in. So to balance it, how do you balance it? So you have your balance carried down. So if you remove 700 from 3,000, so the amount at the end of that year one will be having what? 700 that will be having 2,300 2,300 having 2,300 naira. So sum it up, 2,300 naira, 2,300 naira, 3,000. So that is for this. That's for year one. Close it. Close it for one. Balance with it. Do it to year two. So for year two, we have how much is now the vehicle at the end of year one? Is 6,003 balance brought down. 2,300. That's for second year. And your balance multiplication for second year. Remember, it's straight line. So the same amount. Multiplication. Other 100. So 700 naira. 700 naira from 2,300 naira. You'll be having 1,000. A balance will be 1,100 naira. End of it all, how much are you having in total? Close the account for the year. Close the account for the year. So, year three, balance brought down again from year two. Looking back from year two, what was it? 1,100 naira. Then, during the year, you move your depreciation again from year three, which is again 700 naira. So at the end of the year, what would you now have as balance for the vehicle? Balance will be done in 700 naira minus 1,000. 700 naira minus 1,006. You have 900 naira. You have 900 naira. You have the 900 naira. So sum it up, close it. Sum is 16. So, and the fourth year, the last year, balance brought down. Balance brought down. So what do you have as balance brought down? 900 naira. 100 naira. So during the year, last year, 4th year, the charge was what 700 naira, which is the same. Then another of the year with having a balance of 200 naira. That 200 naira is sold as scrap. That's the 200 naira sold as scrap. That's the 200 naira sold as scrap. So each year, you record the depreciation for the year. So just for example, the trading account we did for that year, if that year was year one, that means in your profit and loss account, you will have this amount 700. It will be in here. It will be in here. The position you put it there about. And when now comes to balance sheet, your motor vehicle has now reduced from this because at the end of the year, balance sheet is showing at the end of the year. So at the end of the year, the vehicle is no more 3,000. This is at the beginning of the year, 3,000. By the end of that year, when you're seeing your balance sheet, amount that is now 2,300 naira. So which is now what we have here in your balance sheet. Motor vehicle, 2,300 naira. That's what is now. So take note of this. So this is for straight line method. So we only have 5 minutes for break, or even 4 minutes. So I think we need to put a stop. Okay, we didn't have 2 minutes left. Also quickly look at, I told you about the using balancing method. So maybe when we come back, we'll now talk also more on the using balancing. So it's just a question and see now, so that you why your break practice. So we have the machine cost 1.5. $12,500. The machine cost will be kept for 4 years. For 4 years. And wood, scrap, the total scrap value of 5,120. Balance of space. Quantity 20%. So the machine cost 12,500 will be set for 4 years. And so that scrap value of 5,120. So the business wishes to use the method called the division balance method. And the rate of substitution will be 20%. 20%. So I would like to stop here. So when we come back, continue from there. I don't want to stop into your break, so you can relax and continue. So we continue in this. So, but just take a look at the question, look at it very well, and we'll come back, we analyze this and everything. So merci. And if you still have 1 or 2 questions, so because after the break, you still have 1 more hour. You still have 1 more hour to go. you have one or two questions again, if you can raise it. So, Matty, can you please take over?
All right, thank you so much, Mr. Samuel. All right, students, you can now go for your break. We'll be back at exactly 1 p.m. Please don't be late. Thank you.